Welcome to Macro Insight. This is my weekly call where I take you through my thoughts on all of the different asset classes out there, which trades I'm looking at, what the main market drivers are and narratives, and how I'm risk managing my positions. If you haven't already signed up to your free 1-week trial, please visit the website link in the description to this video, and that will give you access to the live call with me, and that takes place on Tuesdays at 2 p.m. London time. Hopefully I'll see you there next week. Hi guys, welcome back to Macro Insight. Today is the 8th of December, and let's take a look at markets. You can see my IG screen here. Let's take a look at equities first, shall we, as we always do. Talk about what's kind of driving equities right now. So, we've been pushing to new highs. Kind of at the weekend, we opened up, popped our head above 3,700, only to come back down again. Been talking about sort of over last week, talking about how it's starting to feel a little bit priced for perfection, starting to feel a little bit exhausted. And the kind of reasons why I've been thinking that, have been, obviously the vaccine is out now. You've had the UK be the first country to actually administer any vaccines. A 90-year-old woman had the first vaccine today from the BioNTech one and Pfizer one. And, the US should probably come through and approve the vaccines this week as well. So that story is now kind of out there. And whilst, the vaccines was obviously good news and triggered the rotation and all of that stuff, at the margin now that good news is priced in, right? So if anything, there's potential for disappointment on the vaccine front in that we're not actually going to administer as many vaccines by the end of the year as we might have hoped. So some of the counts in terms of vaccine delivery numbers are getting slashed by quite large orders of magnitude, whereas they might have thought it was going to be, 10 million, and it's like less than 5 million or something like that by the end of the year. So these are sort of disappointments maybe on the vaccine front that could come through in the short term. And then, so that kind of piece of news is out there now. You've obviously got COVID cases exploding in the US post-Thanksgiving. You've got new highs in deaths in the US as well. So you've got California imposing stay-at-home orders and New York also talking about new restrictions. So in the super short term, the Christmas period, whether it's in Europe, whether it's in the US or whatever, is going to be seriously affected by the fact that COVID's still alive and well. And so that's going to put a hole in GDP, right? So there's definitely going to be a hole in GDP around the Christmas period, which is why a stimulus package of some kind everywhere is necessary, right? So there should be some US stimulus package getting agreed maybe this week. They're talking about 700 to 900 billion that they can get through by the end of the year as a bit of a backstop. And then there'll probably be another one next year, a bigger one maybe. So, that's markets kind of holding on to that hope. But then also you've got the flip side where France is kind of talking about the fact that they've missed their goals on COVID containment. So they might have to delay their reopening, right? So you've got this tug and this pull and push, this tug of war between, stimulus and vaccine versus COVID cases still very much exploding and the restrictions maybe not coming off as fast as we would like in places like France and Germany and stuff like that. Okay. Now, in terms of more sort of technical things about the market, sentiment indicators, Goldman's, JP have been out with various reports, like looking at sentiment and saying that sentiment is extremely bullish. If you compare it historically, it's like 2 standard deviations above average, stuff like that, based on whatever data or readings that they look at. Now, how much to read into that is not really clear, but clearly people are bullish. People generally like a seasonal Santa rally and have chased it and played it. And also you've had the news catalyst to get people bullish, right? So it does feel like sentiment and positioning probably a bit on the long side. And maybe there's a bit of complacency in the market for the next few weeks into year end, right? There is also some divergences popping up. So, I've mentioned these before in equities. I don't like it when I see these. Well, I like it in that I like playing it from the short side, but generally when you get these momentum divergences popping up across a bunch of indices at the same time, that's when you pay attention, right? So see these momentum indicator here, peaked in sort of 11th of November, straight after the vaccine news. And then we've reached a new high in spot, like, a few days ago, whereas the peak in the momentum indicator was far, far below that peak. So that's what you call a momentum divergence. That's on the S&P. We look on the mid-caps, Russell, same story. You've been making higher highs in spot, but you've been making lower highs in the momentum indicator. Same story in DAX. That's kind of had its little sort of new high up there about a week ago. So DAX could actually manage to rally last week. So whereas you still managed to eke out some new highs out of the US market, the German market kind of couldn't manage it. So it really does seem to be struggling. Now, there's no acceleration on the downside as of yet. I mean, I mentioned I'd put on some put spread structures, bought put spreads and sold call spreads as a way of playing the bear case in DAX. I'm still waiting for that thing to turn south, but at least it's heading in the right direction. It stopped rallying, right? So kind of watch out for that, but I still expect that to kind of happen imminently. A couple more things that have come up on my radar that I heard mentioned today was something called the Smart Money Index. So the Smart Money Index is basically an index that looks at kind of price action in the market at the beginning of the day versus the end of the day, right? So the idea is that generally retail traders and non-professional traders will trade on the open in the early part of the session. And it's the activity into the close that is more the professional, the institutional money, or the smart money, basically, right? And so these two so if you compare the smart money index versus the normal index, and they diverge a lot, then maybe that's telling you something about the market and what the various participants are doing. So it seems that the smart money index is trading lower to recent lows versus the actual broader market going to highs. So that suggests that this buying is being driven by more retail speculative buying, and the kind of larger money, the bigger institutions who run big money are actually taking money off the table and kind of getting themselves, maybe getting their exposure to equities down in the face of this rally into what is likely to be a liquid period over Christmas. So that could lead to maybe some weakness in the market going forward when we do go into that liquid period and no one's left to buy it, then maybe the market's got some room to come down and correct a bit, right? So that's the idea behind that, to try to identify divergences again, right? About the different flows in the market and who's driving it. And then last thing would be VIX, where, VIX is kind of hanging around at 22-ish levels. The futures on December futures got down to the low 22s last week, but then as the market continued to make new highs, they didn't manage to go any lower. So normally when the market rallies, the VIX goes down. That correlation is quite strong normally, but sometimes you get to a point where the market just keeps rallying and taking out highs that the VIX just stops going down. And usually that's a sign that the market maybe is the vol market, the market makers and the banks who trade volatility, maybe they're a little bit nervous about this level of spot, and it's probably not necessarily going to be that stable at this level of spot. So you may have, like we had in September, we had this big blow-off rally in the tech stocks, and you saw the VIX going up with the market, and that was actually a precursor to quite a big correction, basically, right? So I'm not saying we're seeing exactly quite the same thing going on yet, but there's tentative signs of it. When the VIX stops going down, even though the market's going up, often that can be a precursor to a potential correction on the way, right? So these are all little small signals that saying that maybe things aren't going to be quite so plain sailing between now and the end of the year, right? So I'm certainly watching out for that. I favor some sort of correction in equities over the coming week or two. If it comes, it probably is a buying opportunity of some kind on a more longer term perspective, maybe like a 3 to 6 month perspective. But we'll see if it comes. But that's certainly what I'm looking out for in equities. That's on my radar, basically. Okay, so DXY had a big slide last week, right? So it started breaking down at the start of the week when we talked about it. continued that slide, got as low as 90.5, has managed to kind of hold on there, but is still not feeling particularly bullish. Like if you look at the bars, they're all red still, right? So it tries to have a bounce, but then it finishes the day back down on the day so far. So we haven't actually had a green. We haven't had a green bar in the DXY in a week, right? So now I do feel like things are pretty oversold. I mean, if you look at where the RSI is, I mean, it got to 24, pretty low, pretty oversold level. You know, the momentum indicator, other momentum indicators are kind of, they're not really showing much divergence, I wouldn't say, but they're holding on to support levels, right? So, you know, it does. I wouldn't be surprised to see a 1 to 2% bounce in the dollar over the coming sort of couple of weeks. If that happens, you know, given the correlations in the macro landscape at the moment, that probably brings with it a bit of a correction in equities as well, and commodities and things like that. So I am looking out for that. I mean, potential catalysts, you've got the ECB on Thursday. They're expected to increase their kind of stimulus or their liquidity that they're providing in their pent program. You know, they don't really like to see the euro above 120, and we went to 122. So if anything, they are going to be incentivized to try and talk dovish and maybe try to surprise the market slightly on the dovish side with whatever they say. So, you know, you look at the euro chart, you know, I had been playing that break of 120. I'd said I bought some calls to play the 120 break. We got the 120 break. We went pretty quickly to just shy of 122. I actually took my calls off because they kind of tripled and quadrupled in value. Like I said, the vol was very cheap on the upside on euro. So that was a nice way to play that break. Took those off, took some of them off, sorry, when we got to those highs, because that was kind of my short-term target. Took the rest of them off yesterday, just because I think, like I say, I think the euro pulls back towards 120, maybe even 119 at a push, and I'll probably get a chance to buy calls again, slightly longer dated expiries to play the next downdraft in the dollar, which I think comes early next year, right? So that's kind of how I'm playing the dollar and the euro, basically. Then, okay, so moving on from FX, let's talk about commodities. Another quite interesting space, particularly gold. So this is kind of the chart I posted on Twitter recently. So we had that sell-off, obviously started on vaccine news, sold off all the way down into sort of last week, got as low as 17.63. That had, funnily enough, that had been a support level that I was looking at. So pretty much touched that level and then staged a bounce. I had anticipated a bounce off that level, so I took profit on some puts. Now, how much we were going to bounce was unclear. First fib level was around 1840. That was when I started reloading on puts again, because I didn't expect that the sell-off's just done. We'll talk a bit more about that in a minute, why. But so that first bounce to that's between 1825 and 1840. You know, for me, that it had done enough that it could go back down again. So I started buying some puts again there. And now we've managed to get ourselves back up to 1865, 1870 area, which is kind of the next level. It's the next Fibonacci level, if you look at the retracements from that sell-off. So this is another nice entry point. If you do like selling into this gold rally, it's quite a nice entry point. Longer term, but when we say longer term, I mean sort of 2 to 5 year horizon, still love gold, right? Just for me, the next 6 months, I feel like could be a bit precarious for gold. Yeah. And even though I've got a pension allocation, long-term pension allocation in my pension fund to gold, I would not want to have that unhedged right now. So that's why I've been buying puts. I had been selling calls as well when the market was up here. I was selling calls, buying puts. On the sell-off, I bought the calls back because they pretty much took all their money. They'd made most of their money. Took some puts off. On the bounce, I've started reloading on puts. So I'm spending premium because I don't think the volatility is that expensive in gold, right? So I'm buying puts again. If we continue to rally and we get our head above sort of this 1965 level, which was the pre-vaccine level, then I might start selling calls again, right? But I'm not in a rush to sell calls. Right now, I'm comfortable that I was able to monetize some of my risk reversals on the first sell-off. And now I'm comfortable just accumulating some more puts at these levels because I think there's a down move coming again. But I'm not going to reload and sell calls until we get a bit more of a rally, basically. So that's kind of how I'm positioned. The reason why I think there's probably a sell-off coming, number of reasons. The main one is just that, it feels to me that the news flow on the vaccines, whereas it might have reached a bit of a short-term high, and at the margin, the next few weeks, we might get a bit disappointed as we see, Christmas is going to be a bit of a dud, and maybe the vaccines will take a bit longer to roll out. But the truth is, the market is clearly looking past that at the moment, and will probably continue to look past that over Q1 next year, and the kind of prospect of more growth. So you've got two potential scenarios, right? I mean, it feels like the inflation scenario is kind of there. If you look at what commodities markets have been doing, they are moving in a way to say that inflation is coming. Okay. But the question is inflation coming without growth, or is inflation coming with growth, right? In a world where you get inflation and no growth, that's called stagflation, right? And that tends to be pretty good for gold, because the lack of growth means that bond markets don't go anywhere. Bond markets don't sell off, i.e. yields stay low. And if yields stay low and we have inflation, then real yields go down, right? And that is a nice environment for gold. That's when gold tends to outperform, when real yields go lower, right? That's what's happened this year, and that's why gold did great. Now, the flip side of that is where you get growth and inflation together, yeah? And if you get growth and inflation together, then often yields go up, like bond markets sell off, right? Because people don't need bonds, especially low rubbish yielding bonds. They want the stuff that's got growth in it, basically, like equities, risk assets. So bonds sell off, yields go up, inflation's also up, but real yields actually go up, yeah, because bonds are selling off. And in that environment, gold is trashed, basically. People don't like gold in that environment, right? So gold is very much caring about which way real yields go, and real yields will probably be a function of whether we get growth or not, basically, right? And the market, it seems for now, the market's like giving the benefit of the doubt that we're going to get some growth back next year. And you had Paul Tudor Jones, I believe, talking about a potential massive boom next year because there's a lot of pent up demand, right? We've all been, the consumer has been sitting at home, not allowed to go out. And if they're lucky enough to still have income because they've been working from home or whatever, they're saving that income, right? So there's like this pent up, it's like a horse just before a race is what I think is the analogy that you use. So when you open the gates, they're going to run, right? So when you lift all the restrictions and we have, let's say, call it late spring or summer time or whatever, that we lift a load of restrictions and the world can go out, basically, there might be a hell of a lot of pent up demand to spend and enjoy yourself, basically, right? So you might get this massive boom in spending, that sonic boom, yeah. You might get a massive boom in spending and growth, basically, right? So that's kind of what the market is starting to price some of that in. It's looking past the COVID scenario right now in the short term, and it's looking at the optimistic boom scenario, what happens later next year, right? So it remains to be seen if that is going to play out, but I suspect that story will continue to get priced until we get some major evidence to the contrary, that it's just not going to happen. And I don't think we're going to get that evidence until a bit later on, right? So I suspect Jan-Feb will be a period of optimism, will be a period where things are moving in the right direction. Some massive stimulus bill might come out of Biden once he gets inaugurated as well. All this type of stuff. I mean, especially if they get a blue wave, if they get Georgia or whatever, right? Then you'll be able to pass something big. But the point is, I think that optimism continues on the growth side, and that is probably going to keep a lid on gold in the short term. So I wouldn't be rushing to buy loads of gold right now. Okay, I wouldn't be massively panicking if you've got some long-term allocation that you've had from sub 1500 type levels, but using the fact that vol isn't very expensive in gold and sticking some hedges on, I think is a no-brainer right now in gold, and that's exactly what I'm doing for myself. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.